Welcome to The Explainer. Today, we're doing something I think you'll find really interesting. We're going to take Warren Buffett's legendary investment checklist and put a real tech titan to the test. I'm talking about the semiconductor giant Texas Instruments. So let's put on our investigator hats, right? We're going to sift through all the financial data to answer just one big question. Does Texas Instruments, TXN, does it actually fit the mold of a classic Buffett stock? Okay, so here's the game plan. We'll start with our Buffett Way checklist. Then we'll dig into the business itself, check out its financial health, and tackle that all-important question of price. And then, of course, we'll deliver the final verdict. All right, let's get right into it. Every good investigation needs a solid framework. And ours? Well, it's built on the core principles of value investing, straight from the master himself, Warren Buffett. It's actually a pretty simple approach, but don't let that fool you. It's incredibly powerful. We're going to run TXN through 4 key checks. Is it a great business? Are the financials solid? Can we get it at a fair price? And then we'll wrap it all up with our verdict. Let's do this. First up, the big one. Is Texas Instruments what Warren Buffett would call a wonderful business? And to figure that out, we're not just going to look at the cool chips they make. Nope. We're going straight to the numbers, looking for clues in its profitability. And this brings us to this idea of a moat. You hear Buffett talk about this all the time. He just loves businesses with this huge, wide-open competitive advantage that protects them. And one of the best ways to spot a strong moat is to look for a consistently high return on invested capital, or ROIC. Basically, it shows us how good a company is at turning money into, well, more money. And wow, at first glance, these numbers are pretty impressive. A return on equity of over 30%? That's fantastic. That's a huge signal that this is a business that really knows how to make money for its shareholders. And the ROIC is also super strong, coming in at almost 20%. So both of these numbers are basically screaming, hey, this is a high-quality, very profitable business. But as always, there's a bit more to the story. Okay, and here's where things get interesting. Yeah, today's numbers are good, but look at this. They are way lower than their historical averages. I mean, check out that 5-year average ROIC, 40%. The current number is less than a half of that. That trend, that's a potential warning sign. It could mean that that wide moat we were talking about is starting to get a little smaller. Okay, so next up on our checklist, let's see if the company's financial health tells a similar story. We're going to pop the hood and take a good look at the engine room. And yep, this chart right here really drives home the point we just saw. Over the last 3 years, net income and free cash flow, they haven't just slowed down, they've actually been shrinking. And at a pretty good clip, too. That's a serious headwind you just can't ignore. But here's the twist. In total contrast to those shrinking profits, the management team has this absolutely stellar track record. They've raised the dividend for 22 years in a row. I mean, that is a classic sign of a leadership team that's all about rewarding its shareholders. So you've got to ask, right? How are they doing that if profits are going down? Well, here's the catch. The payout ratio is over 100%. Let that sink in. They are literally paying out more money in dividends than the company is earning in profit. Now, you don't have to be a math genius to know that's not sustainable forever. It's a potential red flag if those profits don't turn around soon. But to be fair, on the bright side, the balance sheet itself looks rock solid. The company doesn't have a lot of debt, and its current ratio is over 4, which means it can easily pay its bills. So we're not talking about a company that's in any kind of immediate financial trouble. Not at all. Okay, so let's recap. We've got a great business, but that moat might be getting a little leaky. And we've got a mixed financial picture. So now we come to what Warren Buffett would say is the most important question of all. What's the price? You've probably heard this a million times, but Buffett's #1 rule is to buy a wonderful company. But, and this is a big but, at a fair price. You never, ever want to overpay. And that means you need to have a big margin of safety. Think of it like a huge safety cushion between the price you pay and what the business is really worth. And folks, this is where our investigation takes a really dramatic turn. On one side, you have the current market price. On the other, the fair value price, which we figured out using a pretty standard discounted cash flow model that just looks at future earnings. And, well, just look at them. They are in completely different universes. So this is the really crucial point. This number is, honestly, it's shocking. Instead of that safety cushion we were looking for, we have a massive negative margin of safety, Over 500%. I mean, based on this model, that is screaming extreme overvaluation. Okay, we have looked at all the evidence. Let's step back for a second, put all the pieces together, and fill out our final scorecard for Texas Instruments. So here's what we found. The business moat, it's strong, but that weakening trend makes it a mixed bag, right? So we'll give it a check mark and a question mark. Financial health, also a question mark. You've got that solid balance sheet, but you can't ignore the negative growth. But the price, that's a hard no. It fills that key Buffett check, plain and simple. And it all just brings us right back to one of Buffett's most famous sayings. It just perfectly nails the huge difference between a company's price tag, what you see on the screen, and what it's actually fundamentally worth. So what's the bottom line here? It's this really clear tension. Our investigation shows that this is a genuinely fantastic company, a real leader. But that quality comes with a price tag that, at least by these metrics, is just incredibly hard to justify. And that leaves us with a final, really thought-provoking question for you to consider. It forces you to weigh the quality of a business against the price you have to pay. And when those two things are this far apart, which one matters more?